All right, so the jobs report came out earlier yesterday. Stocks, crypto, market saw a dip. And before I say this, none of this is financial advice. I love purchasing assets on a discount, meaning when there's red days, it's usually when I'm buying because I get to pad my portfolio. And naturally, when the sentiment flips to favorable, a more favorable sentiment, I make more money, right? So this isn't necessarily always bad, but it's also good to understand where we are in the economic cycle, understand what's going on in the economy, what affects it, how every little thing can be an impact on the markets in general, because that's what runs the world, whether you agree with that or not. So, with that being said, let's watch a quick video from CNNBC going over the jobs report. And then I'll put y'all on game related to some tools that I use to kind of do some further analysis, get my, either confirm or adjust my strategy, and really start pinpointing where I need to be paying attention to. So with that being said, let's get into it. Test, test, test. Okay.
Okay, thanks, Rick. Let's bring in our jobs panel again, Sarah, Ben, and Allison. But Steve, we just, how long ago were you sitting? You were sitting over here. That was today.
I was on the other side there then. So
no, I told you I was scared. I really was hoping for a really crappy number, and it's not so much that that I think that would mean more cuts or a likelihood of more cuts. I just think it would start to make you think that we don't have to worry about inflation so much. But when things like this are happening, inflation, which is already, and I'm not talking about tariffs necessarily, and I'm not talking about immigration necessarily, but add those in. But just where we are.
See, Trump hasn't even entered office yet. And if you follow me on Instagram before I started making YouTube content, you know that I've been speaking about this. Trump is like, does Trump's policies seem to help us more in the long term? Maybe. We don't know. But regardless of who won the election, whether it was Kamala Harris or Donald Trump, obviously Donald Trump won. They were still going to have to deal with the biggest elephant in the room, which was inflation. If we don't have a solid policy to combat inflation, truly combat inflation, not just pause it and, taper it off or delay it, if you will, but truly deal with inflation, we are going to be screwed. Right? And we have yet to see if Trump has a solid policy to deal with it. We don't know yet. But regardless of who won, regardless of who you voted for, if they did not have a good policy to combat inflation or one that could help with the monetary side, the monetary fiscal policy, things of that nature, being able to work with the Fed to have policies that helped on both ends, it's not going to help us. It's not going to get us anywhere, right? So I'm not shocked, to say the least. I'm not shocked.
Just from what's remaining from what the Fed was trying to do in the first place. We weren't there yet when they started cutting. And it doesn't seem like we're there. And this doesn't seem like, and the markets do not like this. And there goes the 10-year and the 30-year. Why am I wrong?
Well, it's like you come home and your daughter kisses you and you say, I'm afraid you're not going to love me in the future. I mean, right now, Joe, you got really good job numbers.
You're just arguing. You're arguing with the markets. I'm not.
Bro, to say 4.14 or 4.2% unemployment rate are good job numbers is hilarious to me. Any other time, those unemployment rates would be screaming recession. But for some reason, nobody wants to admit they were in a recession. Don't know why. I'm cool on the mind games. You have 3 consecutive quarters of negative growth equals recession. That's simple. Why all of a sudden do we want to change the formula? Don't understand. But given the context, for whatever reason, in today's age, 4.1 and 4.2% unemployment rates are good job numbers. Okay.
I'm just
Why
saying,
is it happening then?
I'm just saying.
Just talk about what is not.
First, you're right. You're right in the sense that the Fed had pushed aside this notion that employment was a potential source of inflation. These kind of numbers kind of bring it back in the sense that the payroll numbers themselves are hot. Unemployment rate has been, dancing around this 4.1, 4.2 number. But I don't want to awfulize this number, Joe. I just think it's the wrong way.
You don't have to. You don't have to.
I mean, the market can awfulize it all
What
at
is the
once.
market saying?
I don't think it's right to awfulize it. Okay, I am going to argue with the market.
No cuts.
I'm going to put my hand down.
No cuts.
I think it's no cuts. I think that's right. But we're putting a lot of people to work. We reduce the number of long-term unemployed. We have a little room left to go
always like
on
jobs.
participation.
There's always that argument.
Wages were not
but
that
we're talking
hot.
about markets. There's always the argument that we do want people working. We want people getting.
I don't let
increases.
Wall Street tell me what the right
Sometimes
number of.
And I'll say this: I don't think, personally, I think these numbers are a bit skewed. One, I'm anticipating a revision because under this Biden administration, they've revised the CPI numbers and things of that nature damn near every quarter. Every quarter, which means that they're not presenting the accurate numbers the first time consistently. So I'm definitely anticipating a revision on these numbers. Second of all, I don't think these are people with just one job taking up or lowering the unemployment rate, taking up job positions, creating new jobs. A lot of people that I talk to out here, thank God I'm blessed enough to not have to do this. Thank God some of my family are blessed enough to not have to do this. But there are so many people that I know working 2 and 3 jobs to make ends meet. That aspect, that data point is never represented in these numbers. So that means people are having to work more often just to compensate for the same things that they've been buying. When I talk to people about what it is, what their day-to-day is, grocery bills, things of that nature, utility bills, gas, what have you, rent, whatever. They're not doing anything different. They haven't upscaled their life to some crazy degree to where they're so far out of pocket that they can't afford it. They're buying the same things. They're living the same way. They're not changing they haven't changed their lifestyle at all. Yet they need to make an astronomical amount of money to maintain. So that's the part that is not represented in these numbers.
Depends on what the number. Let's get to.
It is a cynical perspective.
It is, but it's just we are.
Good.
What,
people
we
have
face
jobs.
what we face. Sarah, what are you? Are we over here? Are we seeing the kind of economic activity that would say yes, you were right, Jay Powell, to cut, and yes, we need to cut more?
Well, I think, first of all, when Jay first cut by 50 basis points in September, they might have been a little bit overly optimistic on the view that the employment markets were weakening, which obviously they're not. I think there's 3 factors that determine the path of the markets from here. That is, what does the Fed do? How much tighter do conditions get? And also market valuations. So starting with the Fed, we are already down from hoping for 4 rate cuts this year to 2. And I think today's number is going to take us well below 2 to 1.0, or maybe even talking about rate hikes. Tighter conditions are an issue for equity markets. These higher yields are a headwind for the markets, also stronger dollar. So that's also kind of a negative here, which is why the markets are down. And then let's talk about market valuations. We are currently trading at about 90% versus history in terms of a premium for the S&P 500. So what do we have to take us forward from here?
This is actually a really good chart. So this is the probability of a rate cut before and currently, like after the job report came out. So in January of this year, before the jobs report came out, there was a 7% chance that we were going to have a rate cut. After, down to 3. From March, because You know, the Fed meets this month, January, on the 28th and 29th. Then their next meeting after that is in March. Then you have May, and then so on and so forth, right? So in March, the next meeting after this month, before the job report came out, you had a 40% chance that we were going to have a rate cut. Now we're down to 29, right? And then the trend continues. May, 53% before the job report, down to 39%. June, 70% chance that we're going to have a rate cut, down to 58%. So obviously, the further out we go, the higher the chances are. But for the near term, it's getting lower and lower and lower. To me, I don't think we're going to have a rate cut because we rose rates too aggressively. So if we cut at the same rate going down, we're screwed. We're screwed. Jerome Powell, which is the current Fed chair, if you didn't know, is trying to be methodical about this, right? He's trying to slow walk this dog because he knows that if we cut at the same rate in which we rose, it ain't gonna look pretty out there.
This year, we can't rely on valuation expansion. We're going to need to rely on earnings growth. And can we get that? We can probably get about 6 to 7% earnings growth on the S&P. That takes us for the bulls to about 6,400 on the S&P if everything works out just for earnings growth, which is basically, kind of what we have to rely on here because valuations are going to have a tough time expanding for the S&P.
Ben?
Yeah, so I think that the big number here is not the payroll number, which is coming in much hotter than a lot of analysts expected. But the big number here is the U3 and the U6. So seeing increased tightness in the labor market. This isn't just in isolation. We're on the cusp of a new administration. We're on the cusp of a new administration, which has pledged a very different immigration policy than one we've seen for the past 4 years. So I think this makes the Fed's job harder. The Fed will have to, again, start worrying about wage price spirals and labor-driven inflation, particularly if we see out-migration in terms of immigration and a shrinking labor force. So, that's a real concern. I agree with Steve. Like, in the absence of that...
Yeah, so mass deportations. A lot of companies utilize immigrant work. It's cheaper labor. They have funds to allocate elsewhere. But if you have to hire more Americans to do the same job that you were once paying pennies on the dollar for, that means more money off the books, right? Which means we're going to have a smaller labor force, like you just stated, which could also mean we could see some layoffs because given the current economic state, companies probably don't have that type of bread. Interest rates are high, so they can't, taking on more loans don't sound like a good idea, but we shall see. We shall see. Let's move on to some other stuff that I wanted to show you. So this is over on X. If you watched any of my videos, I have talked about how I utilize X for my investing content, for my outlook on the market, for informational purposes. I don't use X for entertainment purposes by any means. You may see a little here and there, but due to algorithm. But for the most part, I follow people or pages like the Kobisi Letter. I hope I pronounced that correctly, but they basically did a write-up or a thread on why the Fed pivot is officially dead. So we're going to go through that real quick. To get into it, they say the stocks are crashing after the U.S. added nearly 100,000 more jobs than expected in December. The unemployment rate fell to 4.1%, just after the Fed said the labor market was weakening. Meaning, if it was truly weakening, then we would see an uptick in unemployment, not a decrease in unemployment. So how does that lead to the stock market crash? Because that is our very next thing. To begin, the U.S. economy added 256,000 jobs in December, or 92,000 more than expected. On average, the U.S. economy has added 165,000 jobs over the last 6 months. This marks the highest 6-month average since July 2024, when Fed rate cuts were being delayed. They basically go on to say the Fed messed up. Obviously, we saw the stock market crash. S&P 500 dipped. Hey, I ain't complaining about that. I'm not complaining about that. But obviously, the market didn't like what they saw in the job report. Now, getting into inflation and things of that nature, they go on to say, however, since the exact opposite is now happening, jobs jobs gains are accelerating and inflation is clearly back on the rise. Mind you, Jerome Powell and the Fed, their whole goal was to get inflation down to like 2 point something%. Well, we got there, right? Fed, they was patting themselves on the back. You know what I'm saying? They was popping bottles, popping champagne bottles. They thought they hit their objective. Well, there's a such thing as celebrating a little too early, and it may look like they started celebrating a little too early because the Kabisi letter goes on to say this effectively destroys the need for any rate cuts, right? If the labor market is strong and inflation is rising, we need higher rates, if anything. And I said this on my Instagram page. I said this. I said I would not be, they are cutting rates, and I would not be surprised if they turned around and raised rates by the same amount that they cut them. We've only had like 1 or 2 cuts, I think, at this point. 1 or 2 cuts. Now we're going to have to go back, probably not immediately, but they're probably going to have to go back and raise rates by that same amount. Those 2 cuts, we're going to have to raise that back by that same amount, which is absolutely insane. Now on to something that gets into what I wanted to show you, how the 10-year Treasury note and inflation correlate. One of my boys reached out to me. He was buying a house at the time. He was asking me about locking in his rate, this, that, and the third. I literally just looked at the 10-year note. And the fact that, and this was shortly after that first rate cut. Looking at the 10-year rate note after the rate cut, the 10-year note was still ticking up. I said, if you can lock that rate in right now, I would do so. Because here we are. Following this morning's jobs data, the 10-year note yield jumped another 10 basis points. It's now up 120 basis points since the Fed pivot began. Powell described this as something that is unlikely to last. The market is fighting the Fed, and the Fed doesn't even know it. I don't think Jerome Powell is a dummy. I'm not saying that at all. But there is a such thing as being so disconnected from reality that because you are so smart and intelligent, that you make mistakes like this, that you don't see you don't see the forest for the trees. It's crazy. The 10-year Treasury note, the longer the outlook is, basically the 10-year Treasury note, all that is, the yield going up is people feel like the outlook of inflation or the overall economy is not the best. So people buy things like 10-year Treasury notes and earn a yield on those to help fight that inflation for however long they think inflation is going to be. So the fact that the 10-year note is going crazy like this lets you know how people feel about the overall economy and how long it's going to take for us to get things back on track. 10 years at the least. Okay. So let's dive into some of these unemployment rates. I told you I was going to put you on game related to some tools that I use. This is the Fred database. It's free for everybody. Quite literally, just Google Fred database. And this chart in particular is the unemployment rate. So we've seen that, it's been going up and down for decades. 2009 spiked up to 10%. Oh my God. Of course, since 2008, 2009, it has gone all the way down to 3.5%. That's not bad. That's not bad given the context to where they were in 2008, 2009. Since then, we spiked to over 14% in 2020, almost 15%. That was due to the pandemic. A lot of people lost their jobs. You weren't able to go to work, social distancing, all types of stuff was going on. Highest in history, right? Thank God we are nowhere near 14.8%. So where is it at now? We've dipped coming out of COVID. We got as low as, I think the lowest was 3.4, 3.5. Yeah, 3.4%. And we are now ticking back up to 4.1, 4.2% at the end of 2024. Right? So unemployment is low, I guess you could say, in comparison to where we just were in the pandemic. But if Trump's tariffs, mass deportation is going to further impact these numbers, You could see some layoffs. You could see inflation, going crazy because that puts these corporations in a bind. They can no longer get cheap labor, right? They have to pay Americans a American livable wage, right? Companies probably don't have that. So expect to see a not only a shrinking labor force, but also expect to see the unemployment rate begin to tick up. Which it's crazy to say this, but it's easier to turn some things around and bring inflation down when the unemployment rate is higher. I don't know why. There's a whole science to it, but that's the correlation, that's the pattern that I'm seeing. So that's the unemployment rate. Again, this is the Fred database. Use it to your advantage. I look at these graphs all the time because I don't know. It's almost like a hobby for me at this point. All right. So I mentioned how the market yield on the 10-year note matters, right? And it correlates with CPI, inflation, things of that nature. So if you look at this, steady been going up. Our first cut was around here in July. So yeah, at first ticked down, August, September, ticked down, started going up again. Just a minor retracement from here. So the 10-year note is ticking back up. Market doesn't like the jobs report. Market doesn't seem to like the outlook on how some of these potential policies that are being proposed could impact inflation, labor numbers, things of that nature. So people are putting their money in the 10-year treasury note as a safeguard because that's their sentiment. It's going to take almost a decade, really, to bring the economy well within a solid range. That's what they feel. Will that hold out to be true? I don't know. We saw a quick little pump after the election, some euphoria around Donald Trump being elected. So as I said on Instagram again, I thought that pump was going to be short-lived because why? We were going off of vibes at that point. That's it. That we had nothing concrete to show us that we were heading in the right direction. I'm not saying that Trump can't get us going down the right path. I'm just simply saying he wasn't inaugurated yet. He had not truly became the 47th president of the United States just yet. So we just going off of vibes and sentiment at this point. It's pure speculation. So I expected that rally to be short-lived. And as we can see, it was indeed short-lived. So how does the 10-year note correlate with CPI? We are looking at trading economics. That's the website, but this particular data set is United States inflation. So starting in January 2024, we started the year off at 3.1% inflation rate. We started ticking up as the year went on. By end of Q1, we were at 3.5%. We started Q2 at 3.4 and ended Q2 at 3%, okay? Then we started dwindling down. So Jerome Powell and his boys over at the Fed, they were, in July, they were cutting rates. So that's when you started seeing inflation go down to that 2.5, 2.2% range, right? That's where Jerome said, he has historically said that's what he wanted to get to. Well, we got close, 2.4%. All right. Now starting Q4, we starting to tick up. Started Q4 at 2.6%. November, 2.7%. The numbers for December haven't came in yet, but I'm pretty sure they're higher than 2.7%. Pretty sure we higher than 2.7%. Right? And if you look at the 10-year note, not this one, round about in October, we started ticking up on the treasury note yield. So that correlates. That correlates to me. The overall outlook for the economy is not the best. So we're gonna see, right? Given all of that, we've seen the markets dip. Let me show y'all something real quick. This is TradingView. This is my favorite charting software. Yes, I pay for the subscription every month, $20, because I need my indicators. Need some indicators that help me, make decisions on the market, right? I'm not a TA expert by any means, but I know a little something. Something. These are the stocks that I pay attention to, right? All the stocks that I pay attention to, except for one, are in the red. In the red, right? So clearly the market didn't like what we saw in the jobs report. Did not like what we saw in the jobs report. Here's another look at the 10-year Treasury note, ticking up. Crazy. And if you want to look at crypto, the total market cap for crypto took a little hit. We are at 3.2 trillion. I still expect this to go down a little lower. And if you're wondering what these lines are, I use a multi-EMA strategy with fractals and some other indicators. But for the most part, I use a multi-EMA strategy. So this white one is a 21 EMA. We're under the 21 EMA. I expect a retest of this 21 EMA before we go back down. So I would not be shocked if we got to this bottom EMA, which is the 89. So if you want to know what EMAs I use the 21, the 34, the 55, and the 89. If you want to know why, those are Fibonacci retracements. Those are fib retracements. Right? They match the fib, which is another tool that I use. So I definitely expect some type of rebound to the 21 before we hit this 89 EMA, which will be around about 3.4, 3.5 trillion. So crypto gonna take a hit. Treasury note, nah. All of the EMAs are pointing up, bro. We going up. I would not be shocked. Oh, we already retested that fractal. So let's see if there's another fractal around here that we could potentially test. This one up here. Boom. I would not be shocked to see the 10-year note retest that high right there. That's just me. Okay. So what do people normally put their money into as a safe haven? Right? Crypto, that's a risk asset. That's not a hedge against inflation. Stocks, that's a risk asset. That's not a hedge against inflation. Is it good to invest in crypto and stocks? My opinion, absolutely. Not financial advice. Remember that. Always. And if you want to get ahead, you got to invest. That's my opinion. Okay. So what do people tend to put their money into to save their purchasing power? Gold. Gold is what people put their money into. Okay. So during the rate cuts way back in July, gold started ticking up, going crazy, going stupid, right? We had to cool off a little bit, a little retracement, came back below 2,500 an ounce or 2,550, 2,560 an ounce. In my opinion, this would have been a great buying opportunity. I haven't talked about metals on this channel at all, but I'm exposed to metals. And that was a good buying opportunity. I expect with inflation to start ticking up again, I expect gold to go crazy and probably retest that high right there at that fractal. Boom. Right there. So that's almost 2,800 an ounce. I expect gold to make a new all-time high. That's just my opinion. Right? So, and I had yes. Can't forget to show y'all this, because a lot of people, when you talk about inflation, you talk about earning dollars, things of that nature. People don't really understand how their purchasing power is dwindling, right? And how all this correlates. When you hear people on the news talk about inflation and jobs report, you see people who are investing in the markets. They talk about red days and the market not liking this, that, or the other. And you seeing some assets doing well and some others not doing well. Hedges against inflation. So much. It's so much that you got to consider when it comes to knowing where and why you should be investing and where to be investing. So this is, why is this not favorited? That needs to be favorited. Okay. This is a chart of your purchasing power with the US dollar. Starting all the way back to 1913. Obviously, that was the time in which I believe that was World War II, World War One. I can't remember. I'm not a history buff. Our purchasing power with the US dollar is at an all-time high. Since then, we have seen our purchasing power, especially after we got off the gold standard in the Nixon era, just either trade sideways, rebound, or just get completely new. So all the way down here, we have lost over, our purchasing power with the US dollar is damn near in the grave. Inflation, printing money has absolutely destroyed our purchasing power with our native national currency. That is why you hear today more than ever how important it is to invest, because you working. We all hustlers. I'm a hustler. You hustle. I know you getting out there making it happen for your family, doing the best that you can to put food on the table, provide shelter, provide heat, clothing, all types of stuff, gas to get to and from. Pretty sure you got kids, got to get to school, need clothes. They growing like weeds. You know what I'm saying? They eating you out of house and a home. You know what I'm saying? Food is expensive. I already know. I've gotten to the point where I don't even say nothing when we go grocery shopping. I don't even say nothing because what can I do? What can I do? We need the food. My kid's not about to starve. I go to work. Thank God I have a great job that enables me to provide for my family. Absolutely. Thank God. Right? But that don't absolve me from my purchasing power basically being close to zero. We closer to zero and hyperinflation than we are back over here where our purchasing power was at an all-time high. That should tell you something. My dad always used to say this and I never understood until I became an adult and I started making my own money and I had to see for myself why I have to invest. Right out of college, that's when my real education started. Not in college, after college. He said, if people really understood how our money system worked, they'd be riding in the street. Didn't understand what he was talking about, but now I do. This is why it's so important to invest, because you cannot outwork inflation. You'll never be able to outwork inflation. You need to be able to put your money in places that will allow and enable your money to work, do the work for you. Your job should just be a means to an end. Whether you're an entrepreneur or you work in a 9-to-5 corporate job, your job should just be a means to an end. It should not be the end all be all. And generations before me, they would always tell me you need to save, get a good job, go to school, this, that, and the third. Man, well, now that I'm here, that was shitty advice. And that just proves to me not everybody understands how money works. Because if you save dollars, I'm going to use an example that a really good influencer that I follow used a few days ago. Getting paid in US dollar is almost like getting paid in ice cubes. And you're not the one that controls the temperature on the thermostat. The thermostat being the money printer. The Fed can cut it on and cut it off whenever they want to. When they cut it on, imagine your ice cubes, that heat going up. Your ice cubes melting. By the time you get to the grocery store, you got a handful of water, no ice cubes. What you gonna do with that? This is why it's important to invest. I'm gonna get off my soapbox. Again, this is the Fred database. I showed you the Kobisi letter. Follow them on X. Use TradingView. I use TradingView for my charting, indicators, things of that nature. Man, I'm not about to plead y'all to invest for too much longer. I'm not gonna tell you what to invest in. I'll put in me and my co-host, actually, Brandon Lewis. Follow his YouTube page. He putting you on game related to the stocks. I'm putting you on game related to crypto. We both giving you so many tools to use to give you a competitive advantage out here when it comes to being equipped with the right tools to know what to invest in, know how to invest, things of that nature. There's no excuse, man. It's quite literally a matter of survival. You either heed the warning or you don't. You either build or you bullshit. Which one you want to do? That being said, I hope y'all found this information informative. Please give me a like, subscribe. Let me know what y'all think in the comments. I'll catch y'all on the next one. Peace.